Welcome back to the Deep Dive. Today, we're continuing our series, The Other Side of the Table, a deep dive into the investor's playbook.
That's right.
This series, as you know, is all about getting inside the heads of venture capitalists, really understanding how they operate and build those winning portfolios. And for this specific deep dive, we're tackling identifying the why, VC investment thesis and focus. Basically, how do VCs decide where to even start looking?
Precisely. So the core idea today, or let's call it atomic unit of understanding, is figuring out how VCs define their target market, their ideal investment, really.
Uh-huh.
We want to give you a shortcut to understanding the exact criteria they use when they look at a startup.
Right. So our mission is to unpack those key elements that make a startup really jump out to a VC. We're talking market opportunity, the team, the vision, all based on the great sources you've provided. So let's just kick this off. What is a VC actually looking for?
Okay, a helpful way to think about this, maybe reframe it a bit, is to see startups as customer segments for VCs.
Customer segments.
Yeah, just like a regular business segments its customers to know who to sell to, VCs segment the whole entrepreneurial landscape. They're deciding which startups they want to buy into.
Okay. Buying a piece of that future potential.
Exactly. They're acquiring a potential return.
So if startups are customer segments, that makes me think, what segments do they avoid?
Mm-hmm.
Because you see entrepreneurs doing really well in like a niche market, a backwater, as some might call it. They keep more profit, maybe avoid dilution.
Yeah.
Why aren't VCs typically jumping on those?
That's a really important distinction. An entrepreneur might be perfectly happy, thriving in that niche. But VCs, they have a totally different goal.
Right.
Their whole model needs quite high returns. That's the mandate from their investors, their LPs. So they often encourage founders to swing for the fences.
Aiming for the home run, not just getting on base.
Exactly. They're not looking for steady, moderate profits. They need exponential growth potential, something that could lead to a massive exit. A niche market, even a profitable one, usually just doesn't offer that kind of huge upside they need to return the fund.
Okay, so no backwaters. What do they need to see then? What kind of proof points does a startup need before a VC will seriously consider funding? It has to be past the idea on a napkin stage, right?
Oh, definitely. They need to see a clear path and, importantly, evidence that leads towards customer sales and revenues. They want proof of a viable business model and profitability and eventually, actual business level profit and cash flow.
So demonstrated potential, not just a good story.
Precisely. And when they look at a business plan, they're digging into whether management can actually run the business efficiently. Can they buy low, sell high, collect early, and pay late? Basic operational stuff.
Makes sense.
But maybe the single most critical metric they zoom in on is the ratio of customer lifetime value LTV to customer acquisition cost, or CAC.
Ah, the LTV-CAC ratio. We hear that a lot.
And for good reason. It's not just jargon. This ratio is really a crucial measure of the economic viability of how the startup plans to get customers. It quantifies whether spending money to get a customer actually pays off long term.
So it's not just about, is this company making money? Is the way they get customers sustainable and profitable, which hints at future fundraising leverage and valuation too.
Absolutely spot on. A strong LTV CAC tells a VC that the company has figured out a repeatable, scalable way to grow. For every dollar spent getting a customer, they're getting, hopefully, much more back.
Right.
That directly impacts future revenue, future profit, and makes the company way more attractive for acquisition or an IPO down the line. It's proof of sustainable, profitable growth.
Fascinating. Okay, so they've checked the economic engine with things like LTV CAC. What's next?
Yep.
Is this where the big vision and the market size come in? That becomes super important for this specific VC customer segment.
Yes, exactly. Once the basic viability looks okay, investors really hone in on ventures with plausible, carefully thought out plans to address well-defined markets.
Plausible and well-defined.
Right. A solid plan does two things. It gives them confidence in the entrepreneur's thinking, sure, but it also acts as a yardstick to measure progress against later. It defines the initial product, the opportunity they're buying.
It sounds like they want a pretty detailed blueprint. But startups are notoriously unpredictable. How do VCs square that desire for a clear plan with the fact that things change so fast?
That's a great point because there's a really important nuance here. While they want that plan, VCs absolutely understand that businesses cannot be launched like space shuttles, with every single detail mapped out years in advance.
Right. Things rarely go exactly according to plan A.
Exactly. Those initial plans and analyses, they're seen as plausible hypotheses. They expect them to be tested and modified based on what happens in the real world.
So flexibility is built in.
It has to be. Entrepreneurs need to be ready to pivot, to change direction quickly if the data shows the first idea isn't working. It's about being thoughtful upfront, but definitely not rigid.
Okay, a plan designed to evolve. And speaking of evolving, that plan also needs to show the bigger picture, right? The strategic end game.
Yeah.
How the opportunity can grow.
Absolutely. How will the venture expand? New products, new services, more customers, different regions. They need to see that path. Think about Intel.
The Intel Inside campaign.
Right. They had this vision that branding could stop chips from becoming pure commodities. That was a long-term strategic view built into their plan, demonstrating growth beyond just the initial product.
That's foresight.
It is. And underpinning this, the entrepreneur needs to target an industry that's large and or growing and one that's structurally attractive. Scale is just paramount for VCs.
But scaling isn't easy.
No, it's a real tightrope walk. Expanding too slowly can drive away investors because they need faster growth. But expanding too fast exposes a firm to many risks, operational chaos, burning cash too quickly.
So VCs are looking for growth targets that hit that sweet spot, balancing the market pull, investor expectations, and what the company can actually handle operationally.
You've got it. It's not just about finding a huge ocean. It's about having the right boat and crew to navigate it effectively and on a timeline that works for the investors.
Okay. And speaking of the crew, you mentioned the backable management team. It sounds like this is maybe the most important piece of all.
It's arguably right up there. VCs have a keen interest in the people. Because let's face it, a brilliant idea with the wrong team isn't going anywhere. The team is a massive feature of this customer segment they're evaluating.
That makes total sense. So when they look at a team, how much weight do they put on, say, domain expertise? Is it all about the track record?
Well, track record helps a lot. Domain expertise is definitely a big factor. Investors often can't just rely on charisma or intangibles of personality in a pitch. They like credentials, proof you've done something relevant before.
Like Mitch Kapoor.
Exactly. He had a successful software product, Visiplot, under his belt before he launched Lotus. That made him seem like a good bet. Compare that to, say, Bill Gates when he started Microsoft, a teenage college dropout.
He probably didn't look like a safe bet on paper back then.
By that strict, proven track record metric, probably not. Which just shows how much they value seeing that prior success in the field.
Okay, so track record is big. What other personal qualities shine through for VCs?
Beyond just knowing the industry, they look hard for resilience. Can the founder learn from failure? Are they flexible? Startups operate in fast-moving, often brutal environments. You have to be able to roll with the punches.
Any examples come to mind?
Well, there's the founder of Dinar. He openly admitted his business was doomed from the start, partly because he believed what people told me instead of testing their true behavior. Learning that lesson and being able to pivot when the data tells you you're wrong, that's crucial.
Adaptability. Makes sense. And I imagine being able to communicate that learning, that pivot, is also key.
Hugely important. Listening and communication skills are vital. Founders need to be a clear and trusted voice, but also really listen to feedback from the market, advisors, customers, even their own team. The ability to genuinely take advantage of the feedback you get can make or break the journey.
It sounds like it's a whole constellation of traits they're looking for.
It really is. If you bundle these together, the expertise, resilience, flexibility, listening, communication, you start to see what some call the innovator's DNA.
Innovator's DNA.
Yeah, it's this capacity for associating different ideas, constantly questioning assumptions, really observing what's happening, being willing to experiment, and constantly networking.
So it's not just one thing, but how they combine.
Exactly. It's about seeing connections others miss, challenging the status quo, learning by doing, and building relationships. It fuels the passion needed to persevere. Think about Dan Bricklin, the VisiCalc inventor. His drive and that combination of skills got him through incredible hurdles.
Okay, so we've covered the market, the viability, the plan, the crucial team element. Now, let's talk about something that seems like a clear pattern, maybe even a common bias for VCs. Looking at historical investment data, like from 92 to 2004, you consistently see computer software, biotechnology, and communications right at the top, Why the strong preference for tech?
Yeah, that tech bias is definitely real, and there are some pretty solid reasons behind it from a VC perspective.
Okay, let's break those down.
First off, you've got scalability and cost effectiveness. Technology, especially software, can often scale to huge numbers of users with relatively low additional cost per user once it's built.
Right, the marginal cost is low.
Exactly. Think of Skyhook. Their software-based location database approach was reliable, but at a fraction of the cost of building out physical GPS hardware. That kind of leverage allows for the exponential growth VCs are hunting for.
Makes sense. Huge reach, low incremental cost. What else?
Second, there's the viral growth potential. Tech products, particularly online ones, can spread incredibly quickly through networks.
Like Dropbox.
Dropbox is a classic example. They leaned heavily on organic customer acquisition efforts. Basically, the product spread by word of mouth because it was useful and easy to share. Users brought in more users.
So the product itself becomes a marketing engine.
Right. Which means you can scale incredibly fast without your customer acquisition costs necessarily scaling at the same crazy rate. That's music to an investor's ears.
Definitely. Okay, and the third reason for the tech love.
And finally, information technology, IT, is just often perceived as the great enabler of service innovation.
How so?
IT lets companies create totally new services or deliver existing ones in radically new ways, often by leveraging platforms people already use. Skype is a good example again.
Using the existing internet infrastructure.
Exactly. They didn't build a new phone network. They built a service on top of the existing internet, reaching massive demand almost instantly. Tech allows innovation to happen faster, sometimes even structuring the ecosystem to allow market partners to provide ideas, creating network effects that just accelerate everything.
Okay, so scale, viral potential, and enabling new kinds of innovation. That paints a clear picture. So let's try to recap this deep dive. It feels like VCs are quite methodical. They're looking for a very specific type of customer segment among startups.
That's a good way to put it.
It involves a well-defined, large, scalable market, clear vision, but one that's flexible, and critically, that backable management team with the right expertise, the resilience, the communication skills.
And crucially, beyond just the cool idea, they need to see proof of financial viability, like that LTV-CAC ratio we talked about, and evidence the team can actually execute and navigate the chaos that comes with hypergrowth. It's very strategic.
It really boils down to a strategic, almost analytical search for those potential outliers. So maybe a final thought for you, our listener. If you were the VC needing to swing for the fences, what parts of a startup's vision and team would you zero in on? How would you measure that potential? What specific founder traits would really convince you to write that check?
Something to definitely chew on.
Absolutely. Something to think about until our next deep dive.